Welcome to one more video of Canada Accounting Insights. Today we're going to roll up our sleeves and tackle a topic that I know sounds pretty intimidating, Capital Cost Allowance or CCA. But I promise you by the end of this, you're going to see it's not the monster it's made out to be. My only goal here is to make this crystal clear for you. So let's get started. So let's make this real for a second. Imagine you go out and start your dream business, maybe a delivery company, you buy a new truck, and it sets you back $40,000. Now what? You can't just slap that whole 40 grand on your tax return as an expense and call it a day. The CRA would have a field day with that. So how do you account for a huge purchase like that over time? Well, the answer is capital cost allowance. And that's exactly what we're going to master today. So here's our game plan. It's pretty straightforward. First, we'll cover the big idea. What even is this thing? Then we'll get our hands dirty and walk through the actual calculation step by step. After that, we'll look at what happens when you eventually sell those assets, if you will have a recapture or terminal loss. And finally, we'll wrap up with some of the nitty gritty details like the most common rules and classes you'll run into. Okay, first up, before we even touch a calculator, we have to get our heads around the concept. It's like building a house, right? You've got to pour a solid foundation before you start putting up walls. We need to understand the why before we get to the how. Okay, so what is it? At its heart, capital cost allowance is basically the government's term for depreciation. That truck you bought, the second you drive it off the lot, it starts to lose value, right? It gets wear and tear. Well, CCA is just the official system that lets you deduct a piece of that cost, that loss in value against your income each year. It's how you write off your big ticket items over their useful life. Now, here's where the system gets kind of smart. Actually, it uses a pooling concept. So instead of you having to track every single desk, every computer, every chair individually, which would be a nightmare, you just group similar things together. It's like having different buckets. All your office furniture goes into one bucket, all your vehicles go into another. It really does make the thing so much simpler. And that brings us to the most important acronym of the day. UCC, undepreciated capital cost. If you remember one thing, remember this. The UCC is simply the running balance of a pool. It's the value that you haven't used up yet in deductions. Every single calculation we do starts with this number and ends with this number. It's our North Star for this whole process. Okay, so the foundation is built. You know what CCA is, and you know about pools and UCC. Now, for the fun part, let's pop the hood and see how this calculation engine actually works. I'm going to break it down. So it's really, really simple. Whoa, okay. Deep breaths. When you see the official tax form for this, it can look intense. I get it. It looks like you're trying to do rocket science, but I promise you, most of this is just noise. We're going to cut right through it because it really just boils down to a simple logical flow. See, much better. It's really just a four-step recipe. You start with your UCC balance from last year, then you add the cost of any new stuff you bought, then you subtract the money you got for anything you sold. That gives you your new base. And then the final step, you just multiply that base by the rate for that class, and boom, that's your deduction for the year. Let's make this real with our truck example. Say you buy a Class 10 asset for $10,000. The rate for that class is 30%, so your deduction is 3,000 bucks. That's simple. This is the baseline for the CCA calculation. But as usual, the tax rules are always changing. Let's see some important changes that happened throughout the years. For ages, the rule was that in the year you bought an asset, you could only calculate your CCA deduction on half of its cost, just 50%. So, with that half year rule fresh in our minds, let's look at the first massive update that pretty much threw that old rule out the window. The accelerated investment incentive. It was basically a way to encourage businesses to go out and invest in new equipment to stimulate the economy. It let them claim 1.5 times the normal CCA in the first year. It's a fantastic example of how the government can use this system as an economic tool. This is like a massive power up for your first year deductions. And here's the change in a nutshell. The Accelerated Investment Incentive, or AII, basically hits pause on that old half year rule for most stuff bought after late 2018. Instead of cutting your CCA base in half that first year, you actually get to multiply it by 1.5. It's a complete flip, a way bigger deduction right up front. But, and this is a really big but, this awesome incentive isn't forever. It's being phased out. So from 2018 through 2023, you got the full 1.5 times boost, but starting in 2024, that bonus starts shrinking for some key asset classes, and it's going to keep dropping. And of course, it wouldn't be a tax rule without exceptions, right? You can't just apply that 1.5 times multiplier to everything. Pay close attention to classes 13 and 14 that are intangible assets. These are the ones with straight line depreciation for them. The incentive is a little different. And finally, there's an even more powerful incentive out there, but this one is only for specific types of businesses. It's called immediate expensing, and understand it. There's one magic number you have to remember: $1.5 million. Keep this number into your mind. For certain businesses, this is the maximum amount of new assets they can buy in a year and write off completely. I mean, 100% in that very same year. It's a huge deal. So, who gets to use this amazing rule and what's it for? Well, the list is very specific. It was allowed for Canadian controlled private corporations, along with proprietorships and some partnerships from 2021 to 2023, then from 2024 onward. The incentive is only allowed for proprietorships and some partnerships where all the partners are individuals, not corporations. Big public companies are out. And while it works on most property, you absolutely have to know the exceptions, especially those long life assets like buildings in classes 1 through 6. Excellent. So now we know to classify your assets and how to calculate the deduction. But what happens on the other end? What happens when you sell that truck? Or maybe an office building? Well, the tax system has a way to, let's call it, settle the score and make sure everything balances out in the end. And it really comes down to two main possibilities. The first is called recapture. This happens if you sell an asset for more than its UCC balance. The government basically says, hey, wait a minute, you claimed too much depreciation over the years, and they recapture that extra profit by making you add it to your income. The flip side is a terminal loss. This happens when you sell the very last asset in a pool for less than its UCC. In that case, you get to take the entire remaining balance as a final one time deduction. Here's a perfect example of recapture. So, this company had a building with a UCC, a tax value of $180,000. They turned around and sold it for $250,000. That $70,000 difference is the recaptured amount. It gets added right back into their income for the year, and yep, they have to pay tax on it. Now, let's look at the other side of the coin: a terminal loss. In this case, the UCC on a warehouse was 120,000. They sold it for only 100,000. And this is the key. It was the last asset in that class. So the bucket is now empty, but there's still a $20,000 balance left on the books. The rules let them deduct that entire 20 grand as a terminal loss that year. It's a final cleanup deduction. All right, you're doing great. Let's switch gears and talk about strategy. So far, we've talked about rules for big pools of assets, but sometimes it's way smarter to just pull a single asset out of the pool and put it in its very own class. We call this elections. Let's see why this table breaks down three key times you'd make this move. So for pricey electronics over grant, putting one in its own class lets you claim a full terminal loss if it becomes obsolete. For expensive rental properties, it's actually required. This stops you from getting a massive tax bill from something called recapture when you sell just one. And for some manufacturing buildings, it's how you unlock a way better 10% CCA rates. All right, we're in the home stretch last part of this class. Let's lock in two universal rules that you just can't afford to forget. First up is the available for use rule. This is so critical. You can't claim CCA just because you paid for something. No way. The clock for deductions only starts ticking once the asset is actually ready and available for the business to use. The rule defines this as the earlier of two dates, the day you actually start using it or the second tax year after you bought it. Timing is literally everything here. And the second rule is the short taxation year. This one gets people all the time. If a new business starts up in, say, July, its first year isn't 365 days long. When that happens, you can't just take a full year CCA clamp. You have to prorate it. You just take the normal CCA amount and multiply it by the number of days in that short period divided by 365. It's a simple bit of math, but so easy to forget in the heat of the moment. Okay, the last but not least, this might be the most powerful strategic thing we talk about up to now. This quote right here, CCA is discretionary. What does that mean? It means it's optional. You don't have to claim it. Think about that for a second. If your business has a slow year and not much profit, you can choose to claim zero CCA. You can save that deduction for a future, more profitable year when you'll really need it to lower your tax bill. This flexibility is an incredibly powerful planning tool. So I'll leave you with this question. After everything we've gone through, do you still see capital cost allowance as just another boring box you have to check on a tax form? Or do you see it for what it really is, a dynamic strategic tool that you can use to manage your taxes, make smarter investments, and improve the financial health of your business? That's the real lesson here. Thanks for watching this video. If you found it helpful, don't forget to subscribe the channel and leave your like.